welcome in Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Thank you for being here. A lot of excitement about Europe. A lot of guests coming on. They're loving Europe. We're seeing some inflows that continue. What's going on there, and can that outperformance continue?
I think it can. Look, we went through a couple of years where most of the European economies were bouncing in and out of recession because of a very deep manufacturing downturn. That has turned around. In fact, we're seeing data coming in better than expected this year across Europe. The economic surprise indexes are on the rise, and we're also seeing higher expectations. So it's not only beating expectations, but those expectations are higher. In fact, earlier this week, actually on Monday, we got the latest forecast from the OECD, the Organization for Economic Cooperation and Development, a big global think tank that does global economic forecasting. And they once again are expecting faster growth in Europe, in Asia, in Australia, in Canada, in Japan this year relative to last year, at the same time expecting the US to slow down. So that reallocation of money really following where the growth is, both in economics and earnings.
So at this point now, a lot of folks have that in their portfolio. You're likely to see that to continue. We see policy by central banks seems somewhat coordinated still, right, from what you're seeing?
Yeah, that's right. So we got a pause this week from the Bank of Japan, the Bank of England, and of course the Fed. I think the trajectory is going forward maybe a little different. I think there's still room to cut outside the U.S. for most of the world's major central banks, and actually room to hike for the Bank of Japan. But for the most part, yes, we are at the end or nearing the end of the rate cutting cycle, and that suggests investors really focusing more on fundamentals than maybe valuation expansion or contraction. Again, that's bringing investors more and more back to Europe. It really does look like the actions that we're seeing economies, policy leaders take in Europe and China, for example, are really in direct contrast to what's happening with the Trump administration. As they're targeted for tariffs, they're avoiding really confronting the U.S. on tariffs and instead looking to stimulate their domestic economies. Germany this week approved a lot more spending, both on defense and infrastructure. It's helping to drive its economy. We saw the same thing in China with more allocation towards consumer spending, support through trade-in programs and the like. All of that really focusing on driving domestic growth and kind of leaving the roughly 3% of GDP in both China and Europe tied to U.S. sales, exports to, be that as it may. We'll see what happens after April 2nd on that front.
I definitely want to get to the April 2nd story because, it's something I wrote down from some time ago because we knew that was a tariff day and news-breaking day. Quickly, just on the European defense stocks, I've had guests come on and say, I'm not looking at the Mag 7, and we have a new sort of Mag 7, and it's all about European defense stocks. What names go in there, and does that seem like a good play?
I do think it's a good play. Look, I've been on this story all year about the new Mag 7. There are 7 European defense stocks that are really performing very well. They're up about 40% this year, even as the U.S. Mag 7's down around 15% or so. We're in an environment where your investors are trying to look for where they do have some confidence. We're in an environment of uncertainty, and so investors are naturally gravitating towards areas that seem to be more likely to generate strong revenue and earnings growth. And when you look at the numbers, the huge numbers that Europe is allocating towards defense spending, a lot of it's going to spill into these defense stocks. And you've got aerospace in there, you've got weaponry makers, you've got aircraft makers, a lot of them, and they're really seeing very strong upward revisions. They are expensive. They've certainly seen their PE rise on all of this, but the outlook for earnings growth, you're looking at maybe quadrupling spending in Germany on defense over the next few years. So a lot of money pouring in there should justify those higher valuations.
Yeah, understood. And people can look those up because there are a bunch of them. And last but not least, that April 2nd, first of all, I thought it was very appropriate that they chose April 2nd and not April 1st. Because we don't want anybody to start saying it's, April Fool's. The minute when I heard President Trump at some point say, and we'll also have more on April 2nd, I said, oh, geez, thank goodness. So tell me more about April 2nd and what we can expect.
So there's a big report coming out on April 1st, and then April 2nd is probably the first date we will see new tariffs come into place. The U.S. is preparing to announce new and higher tariffs on a wide range of imports and on Europe for the first time this year. Probably a shift away from talking about countries and tariffs to talking about industries, and those industries applying around the world, including on the EU. The EU exports to the U.S. account for about 3.5% of GDP, so a 25% tariff would probably result in a near-term direct hit to the UK economy of about 0.8%. But offsetting that is everything we just talked about: big defense spending, big public investment package, all of that probably more than offsetting the hit to those international sales to the US. All that fiscal stimulus, plus maybe further rate cuts from the European Central Bank, can really help to, I think, support the European economy, which is massively outperforming the US so far this year. And we're seeing it show up in economic and earnings growth forecasts. In fact, in 6 of the last 9 weeks, we've seen net upgrades to European earnings forecasts, whereas we've seen downgrades to US stocks. So all this playing together, despite the outlook for tariffs, maybe targeting Europe there on April 2nd, seems like there's enough stimulus in place to offset that drag.
And at this point now, when we see stocks here in the U.S. lower, abroad higher, but the question is whether or not you're going to continue to see the strength here, or if there are big opportunities at home. Are you starting to hear? Because, I mean, when yesterday we heard lower growth, higher inflation, but most of the folks still have higher price targets here in the U.S. by the end of the year. I mean, 6,000 plus in the S&P. So there's something positive happening here.
Yeah, if we get there, it's going to be on different leadership, though. So what we're seeing is leadership from sectors like energy and materials. Those are inflation beneficiaries. Areas like financials, also a beneficiary of maybe a steeper yield curve and more inflation. So this is a new trend playing out in the market that could have more legs beyond just here the first quarter. So if we get to those targets, it might be on different leadership than the very narrow tech leadership that the market's been used to for the last couple of years.
Yeah, understood. And did I leave anything out? I mean, the dollar's been hovering on a lower level of late. Anything else you're watching very closely?
I continue to watch energy prices. Energy remains the best performing sector this year. It's one of the reasons why the UK stock market continues to outperform this year. The UK stock market, very tied to energy. Nearly 50% of the earnings of the UK stock market come from BP and Shell. So really very tied into that energy theme. So that's another area of the world performing pretty well this year on that lift in energy. I'm seeing, in the face of a lot of red on the screen, we're seeing oil up about 1.6% today. So that's helping to support those UK stocks.
Yeah. Chevron news. All right, Jeffrey Kleintop, Chief Global Investment Strategist, Charles Schwab. Always great to have you on, Jeffrey. Thank you.